chapters covered in the next 1 hour. Our final exam, I'm going to talk about final exam at the end. Our final exam will cover five chapters. Last week we have the depreciation inventory. Remember that, right? This week we're going to talk about marketable securities. Right now, NSA. We talk about mortgage. Then we talk about bond. Okay, so that's what we're going to do. Those 5 chapters will have about 3/4 of the weight to the final exam. So you already get the biggest bang for buck today. Right? So the 5 chapters will have 75% of weight. There's 5 chapters? Yeah. So today, 3. This is number 1. I'm going to have 2 more. And then we have the inventory, we have the PP&E, the depreciation thing, right? Last week. Okay, great. So this appendix is all about how to record a investment. Okay. You can own another company in 3 different ways. Not own, but holding their shares for 3 different ways. The first way here, if you own more than 50%, that company becomes your, what did we call that? We talk about that when we talk in Walmart. Subsidiary. Okay, subsidiary is when you own more than 50%. Then how do you report it? When you put in your financial reports, how do you do that? How do you do it? Remember? It's all just absorb it as if it's 100% owned. And then at the end, you subtract non-controlling minority interest. Remember? Non-controlling interest? That's this case. Okay, this case. You own it, you're the parent. If you are interested in mergers and acquisitions, you should go to the slide, read this part. This is active minority interest. When you own between 20% and 50%. 20% up to 50, less than 50. You are not an owner, but you are active minority. Active minority. You can drive many changes. Clear? You are more than 20%, but lower than 50%. Then GAAP asks you to use equity method. So simply speaking, you can take proportion of your targeted companies gain or loss. Take proportion. I say 25% in the quarter, and then report on your financials. The equity method. Okay, it's not on our final exam, but if you're interested in M&A, you should read that part, our slides. Okay, for our purpose, we only worry about this. When you own less than 20% of a company, you are a passive shareholder, passive owner, passive shareholder. Then we're gonna use a accounting treatment to report the gain or loss and the carrying value of the investment. Okay, so that's our focus. Why do we focus this? Because that's the most common way of owning a security. Like if you buy stock, I don't believe anybody here in this room has the ability to own more than 20%. Right? So most people are minority passive investors. Clear? Yeah. And then if you're a large company, you have a portfolio. The portfolio will have different company stock, but usually it's going to be lower than 20%. Okay, that's why we focus on this scenario, the first one, this scenario. Clear? You are a minority passive shareholder. So this is just, please read this why you do equity investor, why you do the debt investor. We'll talk about this. This is passive, okay, this is what we focus on. Passive, 20%, less than 20%. Clear? All right, so now I want to give you an example. So that's before we do this. Yes?
Is it possible that in a company all investors are less than 20%?
So,
like all stockholders of a company, is it possible that everybody may have just less than 20%?
It is possible. Then they have some correlation. Yes, absolutely. Yeah. So everybody trade. No, there's no parent, right? Everybody has to do the equity method,
right,
or this kind of method. Correct.
So then who controls the future of a company like that?
Well, they build a correlation.
Okay.
That activist investors, only if they have 5%, they can drive changes.
Okay.
If you Bill Ackman, if you look at what he did, it's activist. Great question. So it's counted. Now I want to talk, oops, oh no. Now I want to go through a example. So let's say you bought Facebook stock. Okay. So this is, after I talk about this example, then we move on to the sign. So this is June 1st. Okay, I bought the stock, $100, just some companies stock, okay, $100. So how should I make a journal entry? You spend $100 to buy an investment. So just simply say cash, 100, right? And then you put the investment. Or you can call marketable securities, etc. So this is your passive minority investment. Good? Clear? June 1st. First step. The spirit of GAAP's accounting treatment is to make sure at the year end, the book value of this whatever investment you put in reflects fair market value. Okay, this is very different from anything we have learned so far. So for marketable securities, you must let your book value on your balance sheet date reflect fair market value. So December 31st, let's say this is your year one. Okay, year one. This is for year one. The fair market value of this stock becomes 120. So what's the journal entry? Remember, in the game, you have to make sure on the balance sheet date, the book value matches fair market value. What do? Remember, right now the book value is only 100. That's what you recorded. Now it's another year, you have to adjust the book value to reflect fair market value. What do? Use it again, $20. Remember, you haven't sold it. This is unrealized. Everything just in your hand, you haven't sold it. But the GAAP requires that you adjust the book value to the fair market value. So what do?
Okay.
It's going to be gain, but then on debit side, what do?
Credit side will be.
Nobody knows. You adjust the investment balance to 120. What do? You debit?
$20.
20. Is this clear, everyone? You debit, then you bring up the value, right? You appreciate it to 120. And then what do you do on the credit side?
Gain
Yeah. This is called unrealized or realized. Unrealized, very good, unrealized. Why is unrealized? You haven't sold, okay, you haven't sold, unrealized. Clear so far?
But Professor, why, like I understand that we need to have balancing transaction, but we haven't invested an additional $20.
This is just fair market value. Your investment now is worth 120. You haven't sold it, it's still there. It's just like your stock goes up, right, by 20%. It's the same idea.
So this is sort of like our way of keeping a track of what my investments
Correct.
are right now.
Yeah, it's just,
Sorry.
this is not about dividend. It's just the fair market value of your stock. Fair market value of stock. Yes?
And I just want to clarify, this is like only once at the end of the year, right?
Correct.
Okay.
Well, if you do quarter report, you have to have a quarter report as well.
Oh, okay.
Yeah.
So it depends how often you.
Yeah, right. But if you do this talking about yearly reporting, you don't care about what's on a quarter report, right? You just go to the previous year and the previous year. Clear? Good?
This is about,
Yes.
that's for the company that invested in other company.
Right, this is about her, the company
company
who
A.
buy, yes, yeah, who purchase. Good, so far? Do you see the point of, do you see the difference between what they do with what GAAP trades, this kind of marketable security versus land or building or inventory? Do you see the difference? If it's land, building, inventory, do you write up?
No.
No, unless it's an improvement, remember, improvement of the plan. Other than that, you cannot write up, you can only write down. So because it's marketable security, there is a market, reliable one, so you can write down, and you must write down. Yes.
So what's the logic behind driving up your investments in your books annually, but not your land? Both of them are investment assets in a sense.
Good question. So actually this is a controversial from FASB. if this make the balance sheet and income statement of a company with a large portfolio uninformative. Because this, you haven't sold it yet, right? Maybe December 31st is $120, maybe January 1st immediately become 80. Who knows? The market fluctuates. But just by arbitrarily saying you have to report on the December 31st the value, it's kind of contaminated the informativeness of the financial report. However, fast point is you hold the asset, you hold the investment, so how to find a way to evaluate your performance. So we're gonna use December 31st, whatever the end of the year. Clear? So again, look as if you are the rule maker, as if you are the policy maker. You decide, and your end game is to make sure all the balance sheets reflect fair market value on that day of the marketable securities. Clear? That's why you have to do this. Good? So let's see if you really understand. December 31st, year 3, year 2, you keep holding it, okay? You keep holding it. Now it becomes $90. What do? Now it's $90. Very good. The unrealized loss. How much? 30. Great job. Great job. And then on the credit side, everybody? Investment, right? Very good. Investment, $30. Is this clear? Yes? Good? So now after this journal entry, how much is the book value of this investment?
I have a question. How did you get away with 90?
Oh, I give it to you. That's just fair market. Yeah, on that day, the stock price increased. Right?
There was a factor, I'm fine.
Yeah, very good. So, and everybody, what is the fair market, what's the book value right now? $90? Everybody agree?
Yeah.
Very good. That's the goal, right? So the goal is to make sure December 31st, the fair market value is reflected on the book value. And we did that, right? In order to do that, you're going to recognize gain or loss. That's exactly what we did. Good? Let's say number 4, so May 1st, year 3, you sold the stock for, let's say $150. Okay, this is given the 4th year, the 3rd year you sold the stock for $150. So what's the journal entry?
Investments, credit.
So on the debit side,
Cash.
cash, great job. Cash, how much? 150 given, right? And then on the credit side,
Investment plus
investment's gone, right? The key, how much you put on after investment? How much?
150.
I heard 100. I heard,
90.
anybody here? How much did you put?
150.
No, it's gonna be,
Investment, how much should that
it's gonna be
be?
150.
You should look for the book value, right?
90.
Should be 90, because you have already adjusted your stock to $90 last year at the end of your most recent balance sheet day. Are you good? So once you adjust it, it keeps 90, and now you sold it, of course, that is gone, so you're gonna have 90. Good? Clear?
No, you won't.
And then you're gonna have a, very good. This is realized.
Realized.
Realized. How much?
$60.
Great, we're done. If you really understand what's on the board, you're ready for the final exam for this one point. It is, what's the key is really, you understand, right? The goal is to make sure every balance sheet date, your book value reflects fair market value, period. In order to do that, you have to always recognize gain or loss, right? As even when you still hold it, you haven't sold it, you are required to document this fluctuation as unrealized gain or loss, and then to move the book value to fair market value. Good? And because your book value always got adjusted every balance sheet day, so the gain or loss at the end is not compared to the beginning gain or loss. Are you with me? Is to compare with your most recent book value, which is the most recent balance sheet day fair market value. So it's like arbitrarily make compartments. 1 year, right? Every year is compartments. Are you with me? That's it. That's for this chapter. Let me just quickly go over the slides. Let's do another exercise. Look at Disney. Okay, so Disney company, they bought it for 15 per share, 10%. So this is the passive minority, right? Passive minority. And then let's see the journal entry. They bought it, sure, we know already. And then the cash when they got the dividends.
Sorry, I was just gonna ask you, like, do you think it's more helpful to focus on the slides than the book?
Slides, absolutely, especially the 3 chapters. Always focus on slides.
Like,
The book's so much. Yeah. Yeah.
So-
Only one that you don't understand the part.
Then refer to the book, okay, thank you.
Yeah, no. The slides already a lot, and you are not required to know, like, for this chapter, you only need to know this, you don't need to worry about the equity method or mergers acquisitions, that's just for your own information. Okay, so let's see. You bought it, 120. Wait, is that 100? Oh, 150, okay, great. So when you bought it, you have 150, okay, that's a book value. At the year end of the first year, 2018, fair market value is 120. So your first year, how much gain or loss? Yeah, loss, right? That's why the loss will be 30,000. And what's the book value at year end, first year? 120, great job, you guys got it. Good? Okay, second year, fair market value, year end, 165. So you have a gain or loss? Gain, only 45, you see this? Only 45, because you compare with the most recent balance sheet date, the already adjusted book value. Okay, after this journal entry 2019 at the year end, how much is your book value? 165, great job. Now 2020, you sold it for 190. What's your gain? 25, because now you compare the proceed of the 190 with your book value, 165. Clear? Okay, you guys have to work on the, just review, do by yourself after class. Okay, once you're done with this, you're over. You don't need to worry about the journal entry, but no, it's straightforward. I hope everybody's clear. Equity method, as I said, if you're interested in mergers and acquisitions, you must read the slides. Give you an idea why the accounting treatment is different. Okay? That's all for this chapter, for the appendix. So what did we learn today? For this chapter? 2 things, okay?
Yeah.
One is the percentage, the threshold for to treat different type of investment. What do you mean that if you have a subsidiary? What do you
On
mean
more
by
than
that?
50%.
More than 50%, great. Our method we just did applies to what percentage? 20, below, okay. And then if it's between 20 and 50, you can use equity method. If you read finance news, equity method appears all the time. Because joint ventures, most time you're actually having that within that threshold. Okay. Yes?
How many questions are we gonna have?
Yeah, I'm gonna talk about that at the end. Yeah. Great, so let's move on to chapter 9. So chapter 9 is about the borrowing, okay, borrowing. The most, the borrowing with the lowest interest rate, guess what? It's mortgage, right? Do you know that mortgage is very low, with very low interest?
Mhm.
Why is that?
There's a very tangible physical asset associated with it for the same value.
It's like a collateral. You know, more people understand, we got the house to live, but then the ownership goes to where? Whom? It's a bank. Until the very end, you pay off the ownership transfer. Clear?
But also the time.
Right, the time. So that means throughout this payment period, the house actually belongs to the bank. So it's cheaper to borrow. The interest rate is low. Are you with me? Because the bank has the risk protected, right? Because the house is not. Actually, I forgot to mention, for our case discussion before the break, the bank, remember the matching industry? Banks actually have inventories. Banks have non-zero inventories. Those inventories are what? How you imagine?
Mortgage houses.
Exactly. The default houses properties. So the banks own them and eventually will sell to the market. Are you with me? Yeah. Okay. So that's other things are straightforward. You can read this how interest expense. We mentioned this before. How you pay the interest over time. How you accrue. Right. That's not our concern. Our concern is the most complicated way. That is mortgage. Okay, mortgage. Okay. So let me first go to.
This is my response for 4B. I feel like it's too short form. Because it's for 17 payments, but I feel like I.
Present value of $1. So let me first go over this. So present value of $1. I want to look at this table. Okay. If I give you two options, one option is I give you $100 tomorrow versus I give you $100 today. Which option would you prefer? Today. Very good. It's because there's time value of money. So the future amount is worth less today. Right? Have you heard that? Right? So intuitively, you know that. But in accounting way, in finance way, we say a future $1 present value is smaller than $1. So any future amount of money, you can discount it back to today to give it the present value. Are you with me? So then you are indifferent between two options. Now you can use AI, everything, but this is a commonly used table, present value of $1 table. On this table, you can find the factor. The factor is how you discount back. So for example, you have the interest rate for every period. Not necessarily a year, can be whenever you repeat, right, you're compounding. So let's say 5% a month for 10 months, you're looking at 0.61. Are you with me? Right? That means if I give you one option, $100, 10 months from today, each month is 5% interest rate, that option, you should be indifferent between that option and getting a $61 today. Are you with me? That's called the present value of future dollar. Yes? So that's why everything is smaller than 1, because you are discounting back to today. It's worth less. Yes?
The default period is assumed to be a period or not?
The period doesn't matter as long as the compounding. Yeah, as long as can be a year, can be a month, even can be a day, can be a week. Are you with me? Yeah. Now look at, let's say, find any row. Do you notice that as interest rate goes up, this factor becomes smaller? So that means for a given length of time, the higher the interest is, the discount is heavier. So you're gonna get a smaller present value. Does that make sense? So in other words, it's snowball, right? You discounting back, like make it shrink. The higher the interest rate is, the shrinkage is more severe. It's gonna become much smaller. Make sense? That's called present value of a future dollar. Let's say your mom says, I'm going to give you $1 million 10 years from today. I mean, $1 million 10 years from today. And you both agree, right now, the interest rate of your operations, your business, is about 3%. Clear? So how much does, like $1 million sounds big number. But what is really the present value of that amount? As if you got what, how much? Can you calculate? So 3%, 10 years, so you go to 3 to 10, right? So how much worth it? It's about $750,000, right? So mom said 10 years from now, give a million, it's actually worth about 3/4 of a million today. That's a mini of it, clear? Okay, great, so that's the price value of $1. I want to introduce this, annuity. Yes, please.
Why would we create a system where, like, into the future, it just keeps getting worse?
Keep getting worse.
In terms of like, the value of money is getting smaller. Why did we create a system where the value of money?
This is unfortunately, this is all based on one thing that we are all dying, that's why. Yeah, actually, it is. Yeah, let's say we are forever 21. You know, nobody's getting old. There's no interest. Is that true? Like, if you and I, we always the same, we live forever and we always 21, there's no interest. The interest happens because if I borrow money from you, I'm depriving you from using the money. Right? So that's why I have to pay you for that sacrifice. Yeah, that's why the time value of money is here. Okay. All right, so now let's look at a different table. So is this clear for the price value table? Price value table, good? Yeah, okay, now let's look at the price value of annuity. So annuity is a commonly used financial vehicle, annuity. It's a future cash flow happening at the same interval, the same amount. It's like a mortgage. In the future, they pay to the bank the same amount each month for certain months, right? That's called annuity. Clear? Annuity. And there are two different annuity. Most commonly used is ordinary annuity. Ordinary annuity means that the first future payment happens one period from today. Think about if you buy a house, got a mortgage today. And you bought your house, you close the house, right? Do you need to pay the bank the first mortgage payment today? No, you don't wait until the end of first period, right? Think about common sense. You just got the house. There's no need, you just got the money from bank, right? You are not paying back the first payment, right? You're waiting until the first period. 1 month later, you pay back. Are you with me? That is called ordinary annuity, one of the most common annuity, meaning that the first payment happens one period from today. In asset planning, also very common, like if a rich person passes away, gives the trust, like some money to the future relatives, it's paid out as annuity, in many cases, paid out as annuity. The same amount goes to the people every period. Good? All right, so now we have the same issue. We want to understand what is the present value of a future annuity. Clear? That's our goal. So this table tells us. Okay, so if my mom promised me to give me $100 every month for the next 24 months, 2 years. Again, mom give me $100 each month for the next 24 months. The interest rate is 1% each month. So how much is the worth of this promise to give me money? You go to where? Repeat 1%, 24 months. Each month $100. So in total, it's like how much? My mom's gonna give me $2,400, right? But because that's consecutively in the future, I want to know the price value of that. So I use this table. Go to where? 1%.
Add all those numbers from
24. You see this? Use the factor 21. 21, 24. So that is the factor you're gonna multiply by what? The payment, which is $100. So mom's promise, give me money, translate to $2,124. As if she's giving me $2,124. Is this clear?
Mhm.
That's just to transform your future, convert your future series of money into a present dollar amount. Very good?
Yeah.
Then if that transaction is no longer 1%, it's going to be 5%. What happened to the money's present value? You can imagine, if I move 24 months, before it's 1%, now it becomes 5%, what happened? Move to 5%. that means only 1,400 something, it's 37, yeah. It's good, it's smaller, right? Does that make sense? Because the interest rate becomes higher, got discounted back quickly. Or inflation, you can think about inflation. Like in the future, it's going to be so much higher discount, right? The inflation, so today that worth much less. Is this clear? No? So for the final exam, I will just give you a factor. You don't need to see the table. I will give a factor, for example, I say 2%, 10 periods. What's the factor? From each table, I can give you a factor from a new table, I can give you a factor from present value table. Then it's your job to understand which factor to use. So let me see if you could understand. Quick question. You are gonna go to law school 5 years from today, let's say. Go to law school 5 years from today. You know the law school will cost you about, make up, $100,000 law school. And you wanna save, for that 5 years, the future payment, right? You know you can get 3% interest rate every year, 3%, okay? That's how much you can increase your investment. So how much do you have to save today to put into the investment? Can we find that out? So which table should we use, first of all? Present value table or annuity table? Yeah, very good. This is one-time thing. So you want to get $100,000, right? 5 years from today, and we say the interest rate how much? Let's say 5%. 3%. 5 years from today. So you do the 3% compounding 5 times, right? So 1, 2, 3, 4, 5. You go to 0.86. So what should you do with this factor? You need a future $100,000. So what's the price value, Ashley?
Let me do this with the value table.
Yeah, I think you can ask AI or use Excel, or just Google it. As you Google, you know, you say 10%, not compounding, price and value $1, period. Google will tell you.
And for the exam, we have a table.
Oh, for example, I will just give you a factor. I will tell you exactly the factor. So you don't need to go to the table.
Okay.
Yeah.
We use the present value,
Oh, you don't need to use the equation. I will just give you the number.
but do you get the same number?
It's exactly the same number. Yeah, if you use the financial calculator, it's exactly the same number. Great. All right, are you? Yeah.
I have a question. What's the difference between this table and the previous table? This table, yes, and the previous one, the previous table. There are two tables. What's the difference?
What's the
The difference.
this is a good question. The difference is this present value of $1 is happens only once. $1 in the future. Okay? The annuity table is for the same amount repeating. That's called annuity. Good? Great. So let's go back to our question. Again, we need the $100,000 5 years from today to go to law school. Okay? And our annual interest rate is 3%, right? How much do I need to put the money away today?
I'm assuming if we're compounding it annually, you just go to 3% of the 5.
Yes, go to the tenth. No, that's exactly right. So I need, I need 70, am I right?
Why would it be 10 years? 10?
Oh, 5 years, sorry.
All right, cool.
Yeah, I need 86,000. Yeah, 86,000 to put away right now, so that in 5 years' time, I will get $100,000 for my tuition. Understand? So these two tables' purpose is to convert a future amount today. Are you with me? So all the factors there convert future amount. Yes.
So $86,000 would be $100,000 today. Like the future amount of
Exactly right.
$100,000 in 3 years down the road is $86,000.
Today, exactly right. It's convert a future amount, which is 100,000, to the today's amount, which is
And
10.
that number helps us calculate so if you multiply 100,000 by that, you obviously
Correct.
get that number.
Yeah, so let's say in the future you need whatever $1 million, you still use whatever $1 million that future amount
Yeah.
times that.
Okay.
So we're just multiplying $100,000 by 0.86.
Yes, yeah.
And that final term is our answer.
That's probably, yeah, that's an answer, yes.
So
It's simpler than I thought.
how does this tie into like accounting?
Because we need that for the bonds calculation, for the bonds,
Okay.
yeah.
So if we're doing this on the final, are we gonna be given this chart?
No, I give you a factor, I give you the number. As I said, I give you whatever number on the table, I give that to you.
Could you give an example of like what we use the factor to calculate?
That's the tuition thing I just mentioned.
Okay.
And we're gonna, right now, if you're comfortable with this, we're gonna go into actual exercise. Are you okay with this?
The way you give us a question, I knew that those present value, maybe not like so I'm trying to.
But yeah, we're doing it right now, we're doing it right now. Okay, are we clear now with the two tables? Yes, okay, now let's move on to an actual question. So go back to the slide. All right, so you can read the orders, all right? Let me directly go to the mortgage one. Okay, this is a typical question, all right? It's a typical mortgage question. So the Starbucks purchase equipment $400,000 with a note payable in 3 years. So the format is the same, exactly same as mortgage. Starbucks did not use the own money to borrow money from bank, right? To buy this thing, $400,000. Now the question is how much is each payment? Identical payment for the next 3 years, right? Each payment, principal plus interest. The annual interest rate 11%. So the question is, how much is each payment? Do you see this question? Do you understand what we're doing? So for this kind of question, we first have to figure out what is the present dollar, what is the future dollar. So the $400,000 is present dollar or future dollar? It's present because this is current transaction. Very good. $400,000. What all the mortgage payment, like installment payment in the future, those are all happening in the future. Are you with me? Right? Okay. Great. So you know we're gonna use some table, right? This table, what table are we gonna use? Are we gonna use the present value table or the annuity table?
Can we not just do $400,000 times 0.11 cubed divided by 3?
You can do that as well. Yeah, you can definitely do that. Yeah, you can. But it's not that because you have an annuity there. So I don't think that's that easy. So this is annuity. So let's say you want to use the table. So which table you use? Right, not the present value table, because you are repeating the payment. Clear? So we go to the annuity table. Okay, this one, and how much, sorry? So it's 11% annual, and this 3 years, right? Yes, 3 years, 11%. Okay, so 11%, 3 years, 2.44. Everybody there? So for example, I'll just tell you on the annuity table, 11% 3 years is 2.44. I will tell you. You don't go to the table, you know the factor. Now, what does that mean? So this table is to convert a future amount to present value. You agree? So we don't know how much we need to pay. That's just called X. We don't know the X, right? So this X multiplied by this factor. Are you with me? We multiply this factor, 2.44, will give us the present value. Clear? So what's the present value? $400,000. You guys got it. Therefore, when we type the X equals what? 400,000 divided by 2.44. That's how you get your each installment payment. Your payment. Good so far? First of all, the confusing part is that you have to understand what is the present, what is future. This future payment, right? That's why it's X. And then you have a present, that's 400. Let's just do another mathematical calculation. Before let's look at the table. Imagine your interest rate changed. Right now we're how much? We're 11%, right? If the interest rate drops, going to the left, left. Let's say 5%. within 5%. First of all, intuitively, without looking at table, intuitively, interest rate dropped, what would happen to your mortgage payment? Then the increase or decrease? Decrease, right? So the interest rate drops, what happens to your mortgage payment, everyone? I mean, this common sense intuitively. The mortgage interest rate drops, what happens to your mortgage payment? Decrease, right? So decrease, let's see if that's true. Look at the table. If you move to the left, the same move to the left, what happens to a factor? Increasing, right? Keep increasing. So that means this amount you calculate is gonna decrease, right? Are you following? Yeah, because when the interest rate goes down, you are discounting not as heavy. So that's why your factor becomes bigger, then this whole thing becomes smaller, the payment.
Yeah.
Extreme case, if there's no interest, 0%, what happens, everyone? If there's no interest rate, 0% interest rate, what happens? What happens to this factor?
Gonna be what?
Gonna be how much? If it's 0%, there's no interest. Hmm?
This would be one.
Not one.
It's gonna be.
Not one. You are dealing with, look at here. Right now we are where? 11%, right? We're 2.48. No, not 11%, 2.44 right now, okay? I'm dropping the interest rate to 0. Intuitively, what would be the factor? You're not paying interest. Not 2. You are 3, exactly right, 3. Is that right? Because you are paying 3 payments.
Yeah.
There's no interest. Of course you divide by 3. Are you with me? Now let's look at the table if that's true. We move to the 0, there's actually no 0%. You just keep moving, keep moving. You can imagine what happens when 0. It's gonna be what? 3, right? Does that make sense?
Yeah.
Absolutely, because that's supposed to be 3. Clear? Good? All right. Now let's move on to the slide. So each payment, then we just do, as we said, 400,000 divided by 2.44. Okay, clear?
Yeah.
This is how you do the mortgage calculation. Now let's all go back to the table again. Let's say you want to buy, actually make it up, you got really high salary after you graduate. And you are interested in a house, $1 million house, no down payment, $1 million, okay? You buy this $1 million mansion, and then you want to pay back in 24 months. 24 months. Now the interest rate, I think, if you do mortgage, you can do probably 0.5, or even lower than that, I think. Let's just say 0.1, half point. Okay, that is your monthly, it would be monthly interest. So that means yearly is gonna be 6%. Does that make sense? Yearly 6%, so each month is like half. And you pay, the compounding period is 24. Clear? 24 months. So find out how you calculate the monthly payment for this house.
22.5.
Great, so what should you do, everyone? I would divide, so payment would be a monthly payment. Monthly payment equals what?
1M.
1M on the top divided by
2.96.
2.96.
No,
So I see, 20, yeah, you guys are right, 22.56. Is this clear? Good? Yes.
So we don't consider the units for periods to be anything in particular, because if you said 2 years,
Great question.
then that would have been 1.98, right? So
Yeah, it's a good question. So all these periods does not mean any specific length. It's just saying compound, how many periods you compound.
will we ever be required to work between years and months?
No, but in reality, they do, right? But for our purpose, we always strong. Great question. Is this clear? The table does not tell the year, but it's just a period. Basically, you can You can figure out what is the interest rate for the period, and then how many period, that's it. Are you good? Okay, so you pay, how much would that be, if you wanna do this kind of transaction?
It's gonna be
Next.
4,000.
For first rate, okay. 44,300, right? Around that. When I say 500, adding all the fees. So you are paying back every month 44,500, and then in 2 years you get your house. Good? All right. So now just quickly think. On the slide we have a lot of journal entries. But just think. Your first payment, 44,500. You can imagine among this 44,500, a portion goes to interest payment. A portion, a remaining goes to principal reduction. Can you imagine that? Yes? Yes?
Would you ever ask us for like how much the total interest is?
Oh, no,
over
I
the course
won't.
of 24
Yeah.
months, or you're only asking us what the monthly payment is?
Right, right,
Okay, so you
exactly.
wouldn't ask us to like then calculate what it would be and subtract?
No,
Okay.
not really. No, I won't do that. But I want you to conceptually understand this. Each mortgage payment consists of two components. Two components. One is to pay off the interest for that period, and the remaining goes to reduction of the principal. Is this clear? That's how you pay the same amount, at the end you pay off the whole thing. So at the beginning, the first payment, you imagine this relative size. You have a big chunk goes to where? Interest. Clear? A smaller remaining part goes to reduction of principal. Yes, clear? In the second month, what happens? You think about this breakout. The second period, your interest portion is going to be higher or lower than the first period?
In that or in the first?
You after you pay off the first period and then go to the second period, among the 44,500, you will have a bigger amount greater amount goes to interest payment or smaller amount. Why? Very good, small amount. Why is that? Because the principal shrinked from the first payment. Yes,
So for the exam, are we basically just gonna be calculating monthly payments, or are we gonna need to like implement that into like a balance sheet transaction?
No, not really. But I'll test you if you understand this interest rate or not. Not gonna be like that important balance sheet. But it is clear the second period you will pay smaller interest? Yes or no? Yeah. So then you have a bigger amount remaining to pay off the principal.
So the principal.
Yes or no? So do you see you are accelerating your payoff? So at the beginning, have you heard if you do 30-year mortgage, at the beginning you're not paying off any principal, right? Because you have big principal, so every month you have big interest. As time goes by, you are accelerating, you're faster, paying off faster, because the interest shrink, so you're paying off the principal at a bigger amount. Is this clear? So at the very end, the very last payment, you can imagine a very small portion for interest, a big chunk pay off the principal. Good? So that's all you need to know for the mortgage. This is all you need to know. I mean, we already covered the core knowledge for mortgage. Okay? So that's all for this chapter. You can read, there are many things I put on the slide. All quite useful, I would say. But like journal entry, if you understand journal entry, yeah, it's gonna be very helpful. But overall, once you understand what we did in class, like this question, you're all good. All right? All right, now let's move on to the next one, chapter 10. So chapter 10 is our last chapter. So chapter 9, let's quickly review. Chapter 9, what do we do then? Just the mortgage thing, okay? Especially, I mean, for your own purpose, you should know how to use that table. What, a unit table, the present value table, you can quickly do your own calculation, right? For example, they say, after you graduate from MBA, your wage, your salary is gonna increase whatever. You can please come back today, see how much that is, right? Something like that. But then, that's all chapter 9. Chapter 10, we learn only one thing, bonds. Okay, bonds. Bonds is a way for company to get financed, all right? Company to get financed. Instead of borrowing from bank, companies issue bonds to the public market to borrow money. It's a borrowing. So now we no longer have one creditor. We have many creditors. All the bond holders are my creditors. This clear? That's bonds. And then the slide have all discussions on why you want to do the bonds financing, not other financing. So you don't have to worry about this. Bond rating. Okay, this is the key. This slide. First, I want to understand the cash flow for bond transaction. If I'm the company, you guys are bond holder. I'm the company, you guys are bond holder. When I issue bond on this date, who's paying who?
We are paying you.
Very good. The bond holders are paying me. Is this clear? I'm the company. Then what do I give you in return?
A promise.
Very good. A promise of future payment. See, my promise is all written on this thing. Now it's a certificate, electronic certificate. But you know, before computer came, it's all on a piece of paper. So on that coupon, this is called the bonds certificate. You have several things. The first is the company name, the company, and then you have, this is called the face value. Face value. Face value is exactly how much the bondholder will get at the end of the bond's life, when the bond matures. Okay, so no ambiguity. Everybody will get $1,000, the principal. Clear? And then due in 5 years, so you know exactly when it's maturing, right? And then you know this 10% interest paid semi-annually. This interest rate is always annual interest rate. Whatever you see the amount, okay? Interest rate is always annual. Then pay semi-annually. So that means each month how much you get. Once for this bond, if you have the bond, so that means in every 6 months you get how much? $50, right? Is this clear, everyone? $50. It is very straightforward. Even you only have 1 year or 2 year education. Grandma, grandpa, right? At that time, right? Think about 1920s. In Europe, you don't need much education to know what you expect. You know the date, you know the amount, and they have little coupon. That's why it's called coupon bond. You have little coupon, you can detach. You say, look, this is my first payment, right? My second, you have in total 10 payments. Right, we see? That's why it's also called coupon bond. All right. So once the bonds are issued, all the future cash outflow from the company to bondholders are determined. So all the cash flow from the company to the bondholders are determined, all set, all scheduled. There's no ambiguity. How much money I will pay you guys. Clear? That's why bonds are very accessible, very easy to understand. But what is uncertain is how much you guys pay me. Clear? So this is a question. How much I will pay you is all set. How much you pay me is a question mark. That's why companies raise the money, right? It's different. So let's say, Seabury and I, we're two companies. So Seabury is well established, long history, doing well. I'm a new startup. So we are going to the bond market today. We both issue bond today. So do you think Seabury's interest rate, the market interest rate, just like if Seabury borrow money from bank, and my interest will be the same or different? I'm a startup. Seabury is an established company. Different. So who's going to be lower? Very good. Seabury's interest is going to be lower. So any company's market interest rate is a product of two things. One is Seabury's own, the company's own specific risk profile. Is the company established, doing well or not, risky or not? Also macroeconomic. What's the Federal Reserve's decision on interest rate? Do we have any instability geographically? Like, are we in any war? Like things like that. That's in combination. That's how market give the interest rate to the company's bonds on that day the bond issue. Is this clear? So even on the same day, same hour, we issue bond, we have a different interest rate. Is this clear? That's called market yield or market interest rate. Market income.
It's not different from this.
Yeah.
It's different from the coupon rate. The interest rate just described.
Oh, yeah, so very good question. This is called the coupon rate, okay, this is coupon, has nothing to do with market. This is company arbitrary, always a very nice number for people to calculate easily. 5%, 3%, 2%, so people can, you can figure out quickly. This is not a market rate. What we talk about is this. It's called, next one. The interest market rate. See this market rate. Okay, it's also called market yield. Market yield. I don't want you to see that slide, so I'll come back here. All right. So the market yield is different. Or market rate. Same thing. Is what the market believes your company deserves at the time you issue bonds. How much you should pay your creditors. What your creditors deserve. How much you should pay them. Okay? So this is different from the coupon rate. Is this clear? Who decides the market rate? The market, right, the creditors.
Is it usually higher than the?
Well, that depends. So far, it's clear that the market rate is determined by the market, the whole macroeconomic situation, and my company's own risk, right? Okay, so we just mentioned the interest rate is going to be lower for Seagrade, higher for me because I'm risky, I'm a startup. Let's say I'm not only one company. Today, we are very peaceful, no news day. Versus tomorrow, let's say if we declare war with Canada, let's say, what will happen to the interest rate? Even for the same company, different days. Tomorrow, what do you think the actual interest rate, market yield for me? Will be higher or lower than today? Higher, very good, because we have risk, new risk coming into the market will absorb it, and then your interest rate will be higher. Are you good? Yeah. This is just like borrowing money from bank. On that day, you have the market rate. Okay, now the question is, if the market interest rate for my company happens to be the same as the coupon rate, 10%. Now see, you guys are borrowing money, I'm borrowing money from you guys. The market says I'm supposed to pay you guys 10%. Right, that's market rate. Happens to be exactly the same as on the coupon, on the bonds. How much are you willing to pay me to get the bond?
Not a lot. You wouldn't pay a lot because it's the same as the market rate you could get.
Let's say it's $1,000, just like this. Not Amazon, but GBI company. So you get a promise from me. I'm going to pay you this, do 5 years annually. My market interest rate is the same as 10%. The question is, how much you're willing to pay me to get this bond? Zero?
$1,000.
Exactly right, Noah. $1,000. You're gonna pay me exactly $1,000 today. Then I will keep paying you, 10%. Does that make sense? Is this fair? Because that's what you're supposed to pay me. Right? Good? This is called the coupon issued at par. What's the next? Par value, that means, at par is equal, fair. So coupon rate, the same as interest rate, exact 10%. The bonds issued at the par. The bonds is issued at the face value. Are we good? Do you think this happens a lot? Almost never happens, right? Because you have to have your interest rate exactly the same as the coupon rate is very, very impossible, right? So the actual interest rate is going to be a number that's not going to be 10%. Very good so far? Okay, now the more common case would be, let's look at the first one, less than 10%. If my market interest rate is only 5%, so I'm supposed to pay you guys only 5%. Are you with me? But I have to pay you 10%. Because that's required. I have to pay you 10%. So I'm going to overpay you. Is this clear? I'm going to overpay you for the next 5 years. So how do we make this transaction fair? I'm overpaying you in the future. More than what I'm supposed to pay. So you're going to give me how much? This $1,000 or more than $1,000?
It's more than,
More, right?
yeah.
Because I want to pay you more than I'm supposed to. I'm supposed to only get 5% interest. I only pay you 5% supposedly. But the coupon says I'm going to pay you 10%. I'm going to overpay you. Are you with me? So how can I make this transaction fair? You have to pay me more right now. So you pay me more right now. I'm paying you more in the future. Are you following? Therefore, the bond issued at premium. Premium. Meaning that you're gonna get the payment from bondholders more than the face value of the bonds. Clear or not? Yeah, simply because the actual market rate is lower than the coupon rate. Your company keep paying more to investors, so to the bond investors, the bondholders. So bondholders must pay you more right now. So it's called issued at a premium. Good? What is the opposite? You actually, the bondholders actually deserve 15%, because I'm so risky, I'm such a risky company, new company. The investors deserve 15% interest rate, but I'm only paying them 10%. You see the problem? So I'm underpaying my bondholders. So how do we make it fair? The investor will give me less. Clear? So the bond issued at a discount. The company will get less than $1,000. Then they will give the investors also less than their deserved fair market value, the market rate. So let's see if you really understand this. Go back to that war, like we always count that one. If I issue bond, remember, one issue bond, the face value, everything is the same. I'm already predetermined, I printed, right? Printed out. 10%, $1,000, etc. So if I issue bond today versus if you issue bond tomorrow when we declare war, which day will give me more finance, more money back? Which way I can raise more money? Today. Do you agree? Because today, my market interest rate is lower than tomorrow. Lower than tomorrow. So today I can raise more money. Great job. So the same idea. Let's go to Seabury's example. Seabury has a lower interest rate, right? Her company just less risky. But my company is more risky. So even if our bonds write the same thing, $1,000, 5 years, she can raise more money than me. You agree? Yes? She can raise more money than me because her interest rate is lower. Now last question to you guys. If you don't like the term discount, you just always want to issue a bond at a premium, what can you do? You want to always issue bond at a premium. How can you do that? You can actually do that.
Give extra interest rate than the market.
So you're gonna make your coupon rate, right? Remember, you can control coupon rate.
Yeah.
You're gonna make your coupon rate high or low? Very good. Make your coupon rate very high. So in this case, you're gonna have a coupon rate very high. So your market rate is always gonna be less than your coupon rate. So you're gonna issue bonds always at a premium. Is this clear? Yeah. So the requirement for you guys for chapter 10 is that you understand this directional retention. That's all. You don't need to calculate anything. But if I ask you, okay, I'm issuing a bonds, the market interest rate is the same as the coupon rate. Will this bond be issued at par, at premium, or at a discount? Okay? Yeah, at par, right? Okay, so you have to understand the relationship between the coupon rate and the market rate. So this slide will be very important. But I really hope everybody got the idea of why the bond transaction. This is the most commonly issued bond, like the coupon with every month. You have other kind of bond, like with the auction or everything at the end, lump sum payment. Those are much less frequent. So this wraps up all we have done. So let's quickly review what did we do today. So today we did 3 chapters after break, right? What's the first chapter? We did it. The security, very good, the stock, right? How we record security when we own less than 20%. So our end game is always make sure our balance sheet reflect fair market value. Okay, right down or up, always reflect fair market value. Then we learn mortgage, right? Remember? You really have to understand 2 tables. What do we mean by price value table? What do we mean by the unit table? And then you have to know how to calculate the mortgage payment.
Yeah.
Remember? And then we move on to bonds. Bonds like the borrowing, and then you have to understand the difference between coupon rate and market rate. Okay? And then one kind of bond issued at premium discount at top. That's it. Okay? If you add last week 2 chapters, inventory, FIFO level weighted average, and also depreciation, that covers about 75% of our final exam. Now let me talk about the final exam. Oh, before we do that, I have to, so just quickly say what we learned today, no, not today, the whole semester. I cannot imagine like we did so much in 7 weeks. You don't need to, I'm going to post this slide anyway, but these are just copy paste from your chapter title. Like we started with the concept, remember the first week? The concept, we came very fast. Then we did the balance sheet, dividends, together how we record dividends. Then the income statement and the balance sheet, income statement and cash flow. And then we did the FSA. Even today we talk about the 2-fund compensation, right? Then last week inventory and PPE. And then today we learned the investment, bonds, and the mortgage. That's all. Okay. Before we do the final exam, I need a student. So this is required. We have to do the course evaluation, then we come back to wrap up the course. We have to do this in class. So I will need a volunteer. You have the laptop, right? So just, I don't know how you see, but you can see that. I will need a volunteer, just call me back. I'm going to wait for you. I don't know, it's 10 minutes. I think you can finish probably that's it. And call me back, I'll just wait outside. Is that okay? Yes, thank you very much.
Yeah.
Anyone volunteer?
Sure.
She wants to do it now.
Yeah, I think so.
Working on marketing. She was just looking at me like, what was it?
I was like, what the fuck? I was trying to figure out what we're doing.
Intro to finance.
Yeah, I was like, okay.
Yeah, that's gonna be interesting. Hopefully it's easy to study based on the slides.
Yeah.
Practice it. I don't
Now I'm
think.
like trying to remember how to calculate, but I only remember doing all that stuff in Excel. So,
Yeah. It's gonna be tough. Because you can get we didn't do, what was it NPV?
yeah, when that's I remember doing one formula in Excel, but like trying to like you could calculate the present value, just the PV or that.
But it takes us so much time.
By hand, but I can't remember the formula.
It does take a lot more time.
Why is it 0 credit scores that makes it very dangerous?
The number of hours I spent for this course each week.
Yeah, well, we're in the class. Yeah. investments is it?
Like, less than 3 months.
Gotcha.
In order to do that, like, I would recommend spending more time talking about the chapters and less time discussing the case study.
Mhm.
Some of the chapters were taught very quickly, and it's not for some folks who don't have a background in accounting.
Could do that. That's valid.
So, yeah, I'm gonna give a review for the chapter. Oh, it's just.
Yeah,
It's a recording.
this is what I say. This is my voice.
My name's Sam.
I'm just putting on Karan's accent right now.
It's Tuesday. Some British, you know.
He's like, oh, this is Sam. British must be Sam.
The case goes by.
He was so like ready to fall in love with you.
Yeah, I think it's because he also lived in South Africa too.
Dude, you should just say, yeah, I'm from Chapeltown.
Yeah, you're up in Brentford, from East End. East End is.
You have a very South African accent.
We're never gonna see or hear from that guy again. Well, you did. We all did.
Connection request anything except for that.
That sounds
Did you like get it?
No. Well, I emailed on Saturday, I was like,
Yeah, go get her out. Oh, you did?
yeah.
Who did you have?
Amy.
Where's she from?
She was like, oh, that's fine.
Because they're not gonna be like, no, you're not sick, right?
Yeah, that's what I was saying. But I don't think anybody actually noticed when I left.
We're good.
We're gonna do it.
Okay, can we go her back?
Yeah.
Is this, do we get credit for this?
I think it's still required, so it'll probably be.
Thinking ahead.
Yeah, I thought I was doing one.
You as well?
Yeah. From like the start of the term.
Alright, now let's move on to the final exam. Exam next week. Come here, 3 hours. I promise you, you'll have more than enough time. Because the exam is 3 times longer than the 3 times the length of the quiz, but you have 3 hours. Okay. So you have 40 points in total, 3 hours, 24 multiple choice questions. But overall, you have about 75 to 80% of the points coming from the last 5 chapters. Okay? You have 7 problems. I can tell you what they are. Some of them have multiple steps, so that's why total 16 points. The first one is calculate net income. So I will give you the information and ask you to calculate net income. So you have to understand the flow of the income statement, starting from sales. Then that's the testing if you understand the format. Second one, mortgage, as I said. Okay, I'm going to post this online. Yeah, no worries. The mortgage, just like we did today. If you understand the $1 million mansion thing or the buying the $400,000 the machine, and then also you understand the difference, the 2 tables, because I'm going to confuse you by giving you a factor, the same interest rate length, and give you the factor from $1 table, and then give you a factor from the annuity table. So you have to know which table you're supposed to use. Okay? Yeah. So that's a mortgage question. And the second one is, the third one is bonds. Bonds one does not need any calculation. It's about the qualitative answer. Okay, if, for example, the bond issued at a premium, why? What happened? Okay, so you'll give an answer, not calculation. Next one, FIFO level weighted average. It's just like what we did in class. And the leather jacket, actually simpler than that. Remember we did in the buying some kind of things and giving them on the board. If you get that, you're ready for the weighted average, FIFO level weighted average. All right. And next one, depreciation. This one asks you to calculate. For example, what's the depreciation expense using straight line for a year? And what is the, for example, book value or disposal gain or loss? Purely calculation, no journal entry. Okay? Next one, marketable securities, just what we did today. I give you a scenario, the stock price goes up or down, ask you to calculate the gain or loss or book value, okay? And unrealized gain or loss, things like that. Also, it's a calculation question. Good? Yeah. And the last one, still cash flow. You're gonna see a financial statement, balance sheet. You're gonna create the cash flow from operating activities. You might also be asked to create the cash flow statement for the financing and the investing activities. But the best to best prepare for the last question, just go over the exercise we did in class. Remember the exercise? The last page of the slide. Yeah. Review that, you should be okay. All right, and then if you want to see me anytime this week, send an email and we find the time to do. If you need to go over some let's say, complicated things on the face-to-face, find my TA. She's here, she's in Harvard. Question?
Yeah, so the quiz 1 and quiz 2, for the final, are you gonna repeat those questions
No.
For the, because you know how there's 25% that's based on.
Oh, the 25%, yeah, the 25% is not intentional, because something will come back from the previous chapters. It's gonna be relatively basic.
Yeah, like that 25%, are you gonna like change the numbers from the quizzes?
Oh no, it's gonna be new problems.
Oh,
problems.
you, like,
Yeah.
have nothing to do with quizzes, okay.
No, nothing to do with quizzes. It's gonna be, I don't know how you can review that, but I would suggest that you read the slides. You read the slides. For the chapters, only focus on the things we will talk in class.
Oh,
About
okay.
that, yeah. If you don't have time, don't even read the book. Unless you have a knowledge point you want to really dig deeper, then you'll read the book. Yes.
Will you have a practice final?
Oh yeah, I'll post that. Yes, thank you. I'll post the practice final exam. Again, so feel free to find a time with me if you want to talk, and then I will see you on Tuesday next week.
Is it,
Yeah.
is it open note?
Yeah, open notes, open book. Yeah, open notes, open book. We. Yeah, I'm sorry. The practice flowers. Yeah. So that's any question about the final exam? Okay. So this is the last lecture, but it's really a great opportunity to get to know you. Really honor to know you. We I came from China. I'm really in the Eastern philosophy. We have a term saying the chance for the strangers to get to know each other. The chance is smaller than a blind turtle running into a floating wood in the vast ocean. So think about this, right? This really we should cherish, and we should hopefully we'll get a lot from this encounter. Although I'm not going to be your instructor for the future, but I hope you always come to me if you need anything like different reference or anything, and I would love to hear your great news. But yes, I really hope you take this money mindset with you for both your personal life and for your career. This will really take you far. Right? Thank you, and really appreciate the honor. And thank you very much. Again, email me by the time to talk. Thank you.
Okay, thank you.
Okay.
Sorry.
Yes, question? Oh.
Yeah, we also, personally, I wanted to thank you so much.
Oh, thank you, yeah, great.
For being such a wonderful instructor.
Aw.
So,
Yeah, I think it's really a blessing. I really think this is a blessing that I get to know you guys. Have a chance to influence you.
53 more LinkedIn followers.
Alright, I'll still be around, but because my office in DC, if you ever, and again, remember December 16th, okay?
Yeah.
December 16th, Mark will be here in the afternoon. And we will send a note. I think the school will send a promotion thing. 16th. Alright, I will see you next week.
Yeah, yeah.